freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I am here, as always, with Adam Penn. Hi, Adam.
Hey, Dustin.
A very nice vest you're wearing today.
Thank you. It
looks like you're prepared for cold weather out there.
Well, it was cold. It is cold. It's supposed to snow here this week. It's February in California. We don't get snow. It's supposed to snow 4 inches. I don't think it's going to happen because the weather shows 38. But the forecast right now is showing in Chico on Thursday. Oh, wait, it's changed. Wednesday. Yeah, so Thursday. I don't think it's going to happen. It's a high of 46.
So
we're supposed to get 2.5 inches of rain.
Is it rare for it to snow out there? Like, period?
Like, never in my life.
No, that's crazy. Okay.
It snowed at so we're in the foothills, right? So I mean, you could go 5 miles away and be at 2,500 foot of elevation. It snows there all the time.
Yeah.
But the valley floor, no.
Interesting. Okay.
It's also a problem because January was like all nice weather, so all of the trees are blooming. So like all the almond orchards and everything are like, they have blooms on them, and when the rain comes and hits them and the wind gets crazy like it's been the last week, we lose all those blooms, so then you lose your harvest.
Yeah, I was actually concerned about that around here. We've had I love how we're like bantering about the weather as like old men might do. But
my knee's been hurting.
Yeah, exactly. But no, I mean we've been kind of crazy. I mean, we had like almost a foot of snow here a couple weeks ago, and that's rare for East Tennessee. Like we'll get snow, but it's usually an inch or two or something like that. But to get nearly a foot, it was pretty wild. I was quite excited. I hadn't seen that much snow in a very, very long time here. But then now, like, it's gotten back up warm, and I'm like, this is not good because like we have this like stretch of warm stuff. I was actually thinking while I was walking the dog today, I was like, if this keeps up, these trees are going to start blooming. And then we're just going to have another cold snap. If it back down to the 20s, it's going to kill everything. And then the spring is going to suck because all the blooms are dead and like all the nice, pretty stuff about spring's not going to be there. So
all those damn people drilling oil, ruining the environment.
Yeah, exactly. Well,
have we mentioned our most recent oil investment?
What's that?
Have we mentioned our most recent oil investment?
We have. We actually
we did an episode about it, didn't we?
Yeah, had an episode recently about it. So excited about this episode today. We got a great guest. I think he's the first European guest that we've had, Andreas Schweitzer. So excited. It's kind of a fun connection, I think, that we made here. He's sort of an expert in trade finance. Adam, I can kind of let you dive into it, his background a little bit more. But I'm excited about this. I think we have a lot of real estate folks and real estate adjacent. And this really isn't real estate adjacent, but it's still a pretty interesting investment area.
I think there's going to be a lot of commonalities between what we do in private credit and what he does, and it's I think, you know, it's part of a portfolio, or something you could fit into your portfolio. And from just reading some stuff about him and kind of his background, he's got a lot of experience in it. And then also the trade finance really is a key part of how the world works. So, with that, I think we'll kind of let him introduce himself.
Yeah, let's dive right in. All right, Andreas, welcome to the show. We're glad to have you.
Thank you very much, Dustin and Adam. Pleasure to be here.
So to kind of kick off some of the story about trade finance and just about kind of your industry as a whole, why don't you tell us a little bit about what brought you here and how you ended up in this industry and a little bit of your background?
Yes, thank you, Adam. Delighted to do so. I mean, as a Swiss, what I am, you have 4 business choices in your DNA: chocolate, watches, cheese, and banking, in no particular order, of course. So I skipped the watches and I skipped the cheese, and I did what my father told me in 1978. My son, if you want a safe job, work for a Swiss bank. God bless its soul, that was a while ago and the world has changed. But I did a good traineeship in Swiss banking and realized this was not this didn't talk to me. And I ended up with a chocolate company, chocolate cocoa, called Jacob Suchard or Jacob Suchard. And they were in coffee and cocoa. They owned in the US. They own or owned Brach candies, and now it's part of Mondelez. But to cut a long story short, when I was 26 years old, I was working in Zurich, and I spoke Spanish for some reason. And they were looking for someone who helped in the trade finance business out of Panama in Central America, because that's where the coffee farms were, the cocoa farms, the shipping. So I find myself working in Panama on the Noriega days, if anybody remembers, and was in trade finance. Little did I know. I had no clue what that was. But half a year later, I was running a book of $500 million. And for a 26-year-old, that was for Switzerland's second largest coffee and cocoa company. And that's how it all started. And I loved the trade. I loved the buying and selling and shipping. And I did that for a few years. And Jacobs got sold. And we started a fund, and a market timing fund, which we then sold to an insurer. We did some private equity work, which I could have skipped and probably would have more money in the pocket now if I would have stuck to trade finance. And since 2009, I got back into trade finance. And that's when the banks decided to start moving out, especially when I talk about the banks, I really mean the SME market, the small and medium companies will have, and many of your listeners probably run SME businesses around the English-speaking world, and they will find it sometimes hard to get money from banks. And because banks are highly regulated, all kinds of reasons. You can run a separate podcast on regulations about banks. And that got us into, and we realized there is a market of 3 trillion of non-financed trade. So trade doesn't happen because the buyer has payment terms, a large buyer, which a seller cannot afford. So the buyer says, I pay you in 6 months. And the seller says, sorry, guys, I need to buy a new stock. I need to buy new products. I need my cash. I need to be paid in 20 days, in 30 days. And this is really what we do. We finance the delta between the buyer and the seller. And that's really trade finance on the one hand, or if you come from the invoicing side, it's called factoring if you discount an invoice. And Forbes kindly made a write-up on my book, which I called Trade Works. And we tried to explain to maybe those who are interested in finance and investing why we believe it's a great asset class, and we really like the space. And we tried to talk about the good, bad, and the ugly in it also.
Not only a good background on you, but also an intro into trade finance. I'm pretty sure a lot of our listeners are not going to be familiar with it. I think you did a really good job explaining kind of the high level, right? It's financing that trade between two companies. Can you walk us through kind of at a high level a simple deal or what a standard transaction might look like, just to make it a little more tangible for our listeners?
Yes, you take a pen, or you take a book, or you take toothpaste. You can take anything you find in your office, from the chair to the wire to the computer. Some point this has been traded between a buyer and a seller, and someone has financed it. Now, let's take Dell Computer. Dell had a very good system. Dell said, you order a computer? Okay, once I have your money, I start buying the parts and building the computer. Dell was basically a bank with a computer division. This is how Dell started and was no doubt part of their success. So they had no credit problem at the time. They had no banking problem. They didn't need to borrow money. But they were maybe also in a unique situation at a unique moment. And if you're selling toothpaste, this is a different thing. You have much more competition. And if you have companies, and I stay a little bit in the US, like Walmart. I wrote about Walmart in my book because the Walmart case, which is, of course, public, I mean, Walmart started out with trade finance. They were one of the leaders. So someone would come and say, I buy $1 million for Home Depot or someone of these pens. The manufacturer of these pens says, okay, I want to be paid in 30 days. And the buyer, a Home Depot type of thing, I don't want to advertise anybody, but that's a few names. I almost says, you know what, we pay you in 90 or 120 days. Now, someone has to bridge this. Let's assume the seller is a small company and not a multinational. That small company, the banks give you money on your balance sheet, on your financials. We look at the trade. I'm looking, does this pen have a buyer? And will this buyer pay us at the end? So I look at it, and if it's JCPenney, if it's the Walmarts or the Migros in Switzerland or how they're called, they're good ratings. So I'm probably not concerned. If that company is smaller, maybe I go out and get a credit insurance. I go to an insurance, says, could you please insure the payment of these 50 or 500,000 or 5 million? Or I get a down payment. So this is the process how we look to make sure that we get paid. That's where we're starting at. So we have a buyer, we have a seller, and we try to make sure that we get paid at the end by the buyer, because the buyer is our risk. These trades are 15 days, 30 days, 90 days. We have done this in pharma a lot. We do it in frozen foods from Chile to Europe. We do it in emergency lights you sell in petrol stations in Spain. A petrol station, if they're not part of a big group, and a third of the Spanish petrol stations are independent, they don't have these are mom and pop shops, they don't have big credit lines, not even for 15,000 euros. So there's a lot of credit decision in it, and then to make sure that you have guarantees, personal guarantees. Yeah.
So I think part of what you touched on there is definitely the risk side of it. And I'd like if we just talk a little bit more, because there's two things that I heard. One, that you're looking for a buyer, that that the product is sellable at the end, right? Because that's how you're going to guarantee you get your payment. But the other part I thought was interesting is that you talked about credit insurance. And I'm assuming that insurance has a cost, because I haven't heard of free insurance myself yet. If you do find that, I would love to know where it is. And then the second part is that the insurance is probably something that you factor into your return, right? Because you're going to have that cost. And so how does that kind of factor into the trade there, or into the financing of that trade?
The credit insurance is a huge industry. It's huge in Europe. Each country has a credit insurance, and many countries have more than one. I'm sure the US has many big insurers to give credit insurance. It all depends, where is your country. You see, an insurance in a small African country is probably, if that's your destination, if your buyer is there, is probably much higher than if it's a buyer in Florida or in Switzerland. So it has to do with default, it has to do with volumes, but an African insurer might look at this much differently. So if you insure an African risk, maybe you go to an African insurer who knows that risk much better. If you go to a US risk, maybe you go to a US insurer. And but prices are between very little and a few percentage points. So it can vary. It can vary significantly. You know, if you insure something in Central Asia, take a country like Libya. I'm sure you can get Libyan trade insurance, but probably your premium is higher. But that's how the world is, and you have to factor it in. Maybe your price is 5% higher, and you just have to add it as a cost. It's nothing else than a cost insurance premium. The other way to secure yourself is to take a down payment. You know, if I have a down payment of 30%, a non-refundable one, and the buyer doesn't pay, I'm left with a product at a discount of 30%. It needs to be quite weird. You need to be in a fluctuating commodity that you could risk a downturn of 30%. But if you go back to the toothpaste has no volatility. It's a product that costs X at your pharmacy or in your drugstore. And if I sell the product for 20% less, I made 10% more. And everybody buys it from me because it's 20% cheaper than the market. Or we take a guarantee in the UK, if we discount invoices for medium-sized companies, we get guarantees, we get a mortgage on the house, we get a loan, we get a guarantee from the owner or from the board member. So it's quite a labor-intensive business we do for small rates. And if you read the Financial Times of last December 28th, where Lloyd said we are closing our trade finance desk for SME companies. You see, a loan for $1 million doesn't cost much less than one for 10 or maybe even 50 million. The compliance, the organization, these banks have a big machine they need to run, so they need a minimum ticket size, which SME companies don't have, but 90% of our infrastructure, of our GDP comes from SMEs around the world, roughly. Pretty broad number.
So some questions that brings up for me, and you might have touched on it a little bit there, but is the rates or the yields that you're seeing when you are doing these finances? One, maybe, the yield that you're getting as the investor, and also the rate that the financee was paying. And then second to that is, the size of these deals, right? I mean, I think obviously, like you just said, it's drastically different, but do a bulk of the transactions in this space tend to be in that much smaller size category?
Yeah, our transactions are probably the low end 50,000, the high end 5 million. And the medium range is probably 200,000 to 2 million. That's where I would say is the bulk. But you see, a client could come with a few trades that make up together 3, 4, 800,000. So we deal with a client, not necessarily with a single invoice. We give someone a credit facility. And on the rate side, that is now extremely market dependent. So we are not competing with banks because, first of all, we couldn't and we don't need to, because the bank, if you have a banking line, you borrow from your bank and you borrow cheaper than from the private sector. We are nothing else than a subset of private debt. And private debt has grown into an enormous industry and of billions or trillions of volumes in the meantime from the large asset management firms. And there you are easily in the low double digits. I mean, you look at returns, we can produce between 8 and 10% net. That means we probably pay out 70%. We need to keep 30 for cost, our margin, everything. So, there's a firm up north in the UK, they charge 3% to open the account, just to open the file as a flat fee, and then 3% a month. Now, you're not keeping the money a year, so you're not paying 36%. You keep it 10 days, you keep it 22 days, whatever you need to discount your invoice. But I would say we probably look at 2% gross revenue per month. That's the cost to someone whom we finance. And that's very much, but if you go to one of the big houses, they will not lend us money for less than 18%, 1.5% per month. And I'm not getting money from banks either, because we're a small trade finance, we make 100 million turnover, but we're a small firm in a way. Decent small firm, but still a small firm. And so this is the numbers you're looking at. So an investor probably looks at a net return between 8 and 12%. Depends a bit the country, the market, the sector. You see, software, I'll give you a very strange thing. There's a company with 400 people in Germany, India, and Switzerland. Very, very nice business, exists since 20 years, and does software for government administrations, for cities and towns, and the Swiss government, the German communes, the City of Zurich, and other places. Now, they came to us to discount their invoice. And obviously, the silly question is, why do you come to us to discount an invoice from the Swiss government or the City of Zurich? The Zurich Cantonal Bank, or UBS, does this with their eyes closed. One would think. No, they don't. Because banks say software is not a valuable product. So if the City of Zurich doesn't pay, I can't take this and sell it to the city of Geneva or something. But you see, this is not how we are. This is because you have Basel restrictions. There's a big section in our book about regulations called Basel 1, 2, 3. Now we are nearly at 4. Sometimes you hear it also in the US news. The capital banks need. It's a big issue. So the moment the buyer accepts the product and says, yes, I ordered this software, this is what I wanted, and I pay my invoice in 90 days. My risk is no longer the product, in this case the software. My risk is the buyer, in this case the City of Zurich. And if it's not the City of Zurich, then the credit insurance kicks in, or a letter of credit if we have a product. So, fuel, petrol stations in Spain don't get financed. Why? Because fuel is a dirty product, which you're allowed to put in your car as a banker, but not on your balance sheet. Textile, very difficult because of child labor in countries like Bangladesh, or fast fashion and environmental desert. But still, I've never sat in the meeting where someone said out of protest, I'm not wearing a shirt. So there is a discrepancy between regulations and reality. But we live in a world full of ESG and other regulations, and I'm not arguing this. I'm just saying this is what it is. There is an opportunity, chocolate. They have a client for 300, they make since 75 years, third generation, for 300 million euros chocolate in 5 places in Germany. Wonderful company, terribly solid, private label for the big buyers. The main business of these companies is Father Christmas and Easter Bunny. But in order to sell Father Christmas and not to have Father Christmas in November in the shop, you start producing it in April. You probably buy your cocoa in December and your sugar and what else you need. And the same for the Easter Bunny, you probably start that in October. Now a bank in Germany said, we are very sorry, we can't finance you anymore because of your sector. Now the sector of making chocolate is the same since 75 years. But now someone find out that sugar kills, gives you diabetes. And that's why banks are reluctant to finance sugar. I don't want to ridicule anything, and I don't want to say this is how everybody ticks. This is just what we encounter and why we are in business. So it's, and private trade, private trade wouldn't exist, private debt, if there would be enough banking debt. Private debt exists as an alternative to the existing mainstream financial situation.
So I think with that, one of the questions that comes to me in kind of maybe some of the later part of this episode is, where is the opportunity for investors here? And where do you source your capital?
We are looking that we get trade finance lines, and we find it very difficult because we are in the same bracket as our investors, of course. So, and we are a SME firm. As I said, we make 100 million, 150 maybe this year in turnover. So we are not a big shop, but we produce this very nice margin for our investors and for ourselves. So we like this niche business. And the moment we become much larger, then obviously we have to address a broader audience and our margins goes down, and then we compete with banks, which we have neither interest nor need to. And I don't think that we would even we would win that. Or we love this bespoke business. A lot of effort with our clients in order to serve SME clients efficiently and fast across Europe for the moment. And this is where I put my money, and then my company's money and family money and friends' money. And this is how we grew. And now we have a fund in Luxembourg. And they run managed accounts. And so one thing came to the other. But at the end, of course, I'm trying to see that we get factoring and trade finance lines in the various markets. That's another thing. I realized we have a very good relationship with a bank in the UK, but they said we don't discount Spanish invoices. Now I have to go to Spain to get a invoice discounting line in Spain. So we are really in a bespoke business, tailor-made, which is an expensive exercise, but this is how we decided to run it. It's not something you can outsource to India. We have accountants, we have lawyers, we have people from large banks who joined us. So everybody does this business who is with us for quite a while.
You are obviously very bullish on this space. You have decades of experience in it. It's what your business is built around. But where do you see, if obviously someone's not going to go out and start this business themselves, most likely, but you said that you do take some capital from friends, family, you've got the fund in Luxembourg. Where do you personally see this in someone's portfolio? Is it a large piece of their portfolio, a small piece, just something they do with excess cash, or how do you see that kind of fit into a personal portfolio?
Everybody has their own needs in a portfolio and their own environment. Some people need cash, some people want revenue, others want capital gain, their tax. So I couldn't say what portion it should be in anybody's portfolio, because that is different. All I know, I think it is a wonderful replacement for it is a wonderful fixed income product, because that's what it is. At the beginning of the trade, I know my margin. I know we sell to 17.50, we buy at 17.50, we sell at 20.50, I have a cost. It is very predictable. We are not making plus 20%, but we're also not making minus 20%. And we had one client who didn't become a client, obviously, 2 years ago when tech stocks went up. He said, look, why should I invest with you? Tech stock went up 50%. And says, yes, it's like asking me horses for courses, a complete different thing. If you want to drive an AI energy highly leveraged portfolio, because this is what you understand and what you like, by all means. Others like fixed income, and we are much more on the very low volatility and fixed income. So I'm happy to share this link. I wrote a couple of articles on Forbes, Alpha and trade finance, the ESG with trade finance, the risk and trade. So if you wish, happy to share it with your listeners yeah. So if you like a stable return, a predictable return portion, then do that. And we get quite some money out of Germany at the moment from asset managers who park their cash in that, because we need 3 months notice to give the money back. And why do I need 3 months notice? Because most of our deals last 90 days. So otherwise I have to keep too much money for liquidity. So it's a reasonably liquid, low volatility, low risk investment, the factoring side and the trade finance if it's insured. Now some will come and say, but we read that there was a huge case with 500 containers of copper about half a year ago. I'm not mentioning the company involved, but you Google fraud of 500 copper containers and you get the big trade company out there. But that's organized crime. If someone replaces in 500 containers coppers with stone or other metals, this needs more than just one crook. This needs a serious organization to do that. Of course you have that. And I also wrote, I have a couple of chapters where I say, I write about, to keep this book a little bit more interesting, I wrote about the fall of bearing banks. I wrote about the Kuwaiti stock market crash, which I don't know if that anybody remembers. It was in the 80s, but sort of there are a couple of interesting examples in the book. Yes, of course, things go wrong. And we also had things that went wrong. Then you have to recover. But it's that's why you need to have a good level of security, so that you should be over collateralized. And that's why I like, I get a guarantee from a board member or a lien on the house of the owner, a mortgage, the guys will pay us back before he loses his house. Credit insurance, you have to wait. Credit insurance is good, but it's sometimes not so easy to collect also.
I think there's a lot of parallels here to, Adam and I we're partnered in a private credit fund specifically for real estate. And it's just interesting hearing a lot of the same concepts and ideas, and even some of the things about we sort of, in that fund, we target the kind of that missing middle that is they're too large to be financed by the small banks, and they're too small to be financed by the big banks. And so, and you talk about knowing locking in your return at the start of the deal. And so it's just, this has been fascinating for me. I always love niche finance stuff. And so I think the parallels here between this and then like real estate private credit, other types of private credit, which, I mean, that's effectively what this is. I think it's fascinating. And I guess to kind of piggyback on, I think it was Adam's question about where this fits in a portfolio, I can very easily see this fitting in that fixed income spot. And we get some investors that make the same comments too, right? They're like, well, my portfolio of tech stocks has just been through the roof the last 5 years. Why should I invest in this? It's like, well, okay, like you've had some good returns, but you're probably discounting the amount of risk that you've actually taken on in that portfolio. And so it's probably not going to keep going to the moon forever. There's definitely a place for this, regardless of what it looks like. If it's trade finance, if it's real estate private credit or business private credit, like there's definitely a place for this, I think, for most investors. I want to be mindful of time, Andreas, and ask you, we always like to ask each of our guests, we're the Wealth Independence Podcast. And so we like to ask, what those words, what independence and freedom, kind of like what that means to you, how you manifest that in your daily life, and just sort of what your take on those words are.
I think a big freedom is to get my money out when I want to get it out. That's that we can deal as we want, how we want. We can invest in markets we like, and today we have a lot of restrictions, and regulation reduces this freedom to operate. In a way, it gives us freedom to operate because we deal in markets that are not so regulated, but it also makes this freedom to operate much more difficult. And I really wish we get less bureaucratic and less regulated. And I think the Americans, the US, are much more advanced on that backswing than we are in Europe.
I would completely agree with that, even though I feel like we're sort of trending in the wrong direction at times, but definitely comparatively, I feel like it's a lot better.
The saying, but how did the saying go? American innovates, and then the Chinese duplicate, and the Europeans regulate. So we're better.
Regulate,
I have a chart, I think, on page 130 something, and it shows very nicely that each time you have a market crash, be it Black Friday in '89, be it 2008, you have a big upswing in regulations and regulatory demands. Every government person will say, "Oh, we have to regulate and protect the investor." And about 5 or 8 years later, "Oh, this is too tough, too expensive. We do it." So, and that's why it goes back and forth. So but we like real estate. We also like, for example, in Europe, the opportunity, which I basically look as trade finance nearly. It's non-performing loans. We have a lot of non-performing loans. You buy the loan, you get the real estate as an asset. You're highly secured. So it's that's really we are one trick pony. This is what we are focusing on.
Nothing wrong with that. Nothing wrong with that at all. No, that's awesome. Well, Adam, I don't know. Do you have any other questions? That's you, Adam. You asked about every question I had, so I think you covered it pretty well.
No, I think we're good. We can probably call this one a wrap, and maybe we'll have you back on for another interview soon.
Yeah. Andreas, we appreciate you being here. It was great talking with you.
Thank you very much. And I'll send you these 4 links, and then you can decide if you want to share them with your audience.
Absolutely.
And if you like to read it there. Yeah.
We'll make sure those make it into the show notes.
Thank you very much for calling me today and for your interest. Great talking to you.
Absolutely. Thanks, Andreas. Well, that was great. I was, I think that kind of lived up. I don't know. I mean, you know me, I get naturally curious about a lot of stuff. And now I'm like thinking about all these things and I'm like, oh, are there like, where are the investment opportunities and could we do this? And then it honestly kind of opened my eyes to a space that I guess I never fully realized existed. Like you just don't, I think unless you're dealing with these sorts of businesses and you have these problems, which, you and I don't deal with we're not selling a physical product, right? Like that's not something that we typically deal with. So this isn't a need that we usually have.
Well, I've always considered like I bought building material and stuff and had like a net 30 payment plan, but I always assumed it was just, the supplier was giving me net 30, right? So I didn't really think that there was this kind of middle layer trade financing, which makes a whole lot of sense. I thought some of the examples he had, I actually think me and him probably get along really well. He doesn't seem to be a big fan of regulation, but some of the stuff that it just seems ridiculous, right? You've got this local bank who won't finance software to the City of Zurich, right? Like, probably by regulations put in by the City of Zurich on those banks. So just some things like that were interesting stories to hear about, and it makes sense why there's an opportunity there. I think, like we even mentioned, like you mentioned on the credit fund, right? There's an opportunity where regulation, other items might not allow other entities to do it.
Yeah, for sure. No, I think it's just yet another example of where if you can, any sort of business, right? If you can find this like underserved segment and then go in and be able to serve those needs, you typically do well. And I think I think it's funny to hear him talk about them being a small shop at $100 million turnover per year.
Yeah.
But that's good, right? I mean, I think that speaks to the demand and obviously a lot of nuance there. And yeah, I did have the thought when he was talking about regulation. I'm like, yeah, I know Adam's going to be nodding along pretty well right there. So, but no, that was good. And I think we didn't mention it during the recording, but we'll make sure to put links to his website, his LinkedIn. He's also mentioned the articles in Forbes. We'll have those linked. We'll also link to his book. So all the ways to get in contact with him will be in the release notes. We'll make sure all that gets there. Well, Adam, any parting thoughts?
No, sir. I think it was a good interview.
Same here.
Look forward to hearing what people think.
Yep, absolutely. As always, if you like this, give us a thumbs up, positive review on Apple Podcasts, like and subscribe and all the fun things and whatever you do on Spotify. But we appreciate it. We'll look forward to seeing you on the next one. Just remember, where freedom leads, where wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.